So 62% of these funds have failed to outperform. What are we talking about? Mostly actively managed schemes. How do you look at it?
See, Kavita, to my mind, it's not a big surprise. See, if you have 152 fund managers managing 380 active schemes, all will not be able to beat their respective benchmarks. If the brighter side is 91% have outperformed, and you need not more than 5, 7, 8, 10. If your proportion of the schemes you buy, let's assume you're buying 10, and if you're mathematically buying 10, can you pick and choose that this ratio is just the opposite for you? Right? If 62 have underperformed, 38 have outperformed, can you use mathematics to make sure that 70% of your schemes outperform? Yes, the answer is yes. So writing off the full active management might not be the best strategy. That's what I see this data. Now, for example, Anand Rathi started its model portfolio creation in 2013, June. From there on, we have bought and sold 38 funds. We have bought 36 funds. We have sold in 9.5 years. The average per annum alpha over Nifty has been 3.23, right? So, not that we didn't pick up any underperforming schemes. We picked up at least 30% of our schemes were underperforming schemes, but the 70 choice can make up for the other 30. That's what I see this data as. But it's not a surprise for me that close to 60 of them have underperformed their respective benchmarks, including the dividend. So,
but then Feroze, let's take it category wise. You know, I think that is when the number really stands out if we divide it that way. Because if you're talking about large cap category, you know, around 20 schemes out of 24 have underperformed their benchmark, and here it's almost 83% of underperformance. Large and mid cap category and mid cap category, 18 schemes in large and mid cap category, and mid cap there are around 14 schemes, almost 78% of underperformance you're talking about. ELSS funds, out of 27, 19 schemes have underperformed, which translates into what, 70% of ELSS. Now, when we look at the figure like this, then it's a huge dip. How do you think this gets translated in the overall performance of these kind of categories then?
See, I think, like you said, ELSS, for example, it just reaffirms my belief that any fund manager who gets locked in money, his enthusiasm to generate an alpha becomes that much lower. The fear of losing assets which you have built over 5, 10 years is one of the huge motivations of paying so much attention. So whenever people have asked me, should I invest more than the ATC limit in an ELSS scheme, then I'd say absolutely no, because there's another study we did, wherever there are lock-ins, the same fund manager is a lot more lethargic than an open-ended scheme. This is a study which we did across 10 fund managers who manage both open-ended and closed-ended schemes. That's one thing which came out from the data point. Now, large cap scheme has a different reason for its underperformance. See, large cap as a universe is the top 100 stocks. Where does extra return come from? Your deviation from your benchmark is what will give you extra return. Let's assume if I have 100 rupees, if I invested 70 of my rupees exactly like the benchmark, it is cancelling with the benchmark, then the 30 has to give me that extra return because the 70 is nulling off, right? So in large cap, the active weight, this phenomena is called active weight. Matlab main active kitna weight le raha hu, right? What is cancelling out? So large cap has the least active weight because large cap is the most well-defined smaller universe. So that has to deliver lesser alpha and a lesser number of schemes which will generate alpha. Both counts, it is clearly disappointed because of this cause, which is lower active weights.
Here, 4 categories I would really like to highlight where we saw the underperformance, in fact, going down or reduced. Value funds, out of 11 schemes, only 4 have underperformed. Small cap, only 1 out of 10. Multi-cap, total schemes, I mean, the performance has been fine for multi-cap and contra fund. What could be the reason behind the SIPs not outperforming or performing well, in fact, in these categories?
See, Kavita, the data which you threw up on small cap funds is my primary reason why I believe in fund management, which is active. In a small cap fund, if you check that the fund manager actually has lesser correlation, lesser cancellation with the index, which it is tracking. So it has more active weight. 80% of the portfolio will be active weight, only 20% cancelling with benchmark. when he is given a freedom of having an active weight of 80%, he is generating and beating the benchmark. That's point one. Point two, in a small cap category, you are not so dependent on macroeconomics. You are dependent on microeconomics of that business, right? So there, does the fund manager have the capability to identify businesses and managements which will deliver their promises in the form of earnings? The answer is yes. So small cap, because of its higher active weight, because the benchmark is reasonably large, that's point one. Point two, that fund managers are able to identify small cap businesses by meeting professionals who are running those businesses, which a retail client can't do, right? Is a fund manager meeting the top 5 companies of Nifty? Not as much as those smaller stocks. So small cap funds, because of active weight and the personal interaction which you will do with the managements of those companies, will give you a better sense, which a retail guy can't do, is why he's using the mutual fund route in the first place.
So one thing is clear that looking at the data, you cannot really decide whether you want to go through an active route or the passive route. Now, that's not the call that one should be taking. This is just a study that we are discussing and the data that's coming out of it. And also, this is a 10 years performance that we are talking about as compared to the benchmark. But then there have been period and times, Feroze, where these categories have in fact outperformed the benchmark and done that really well. If you could just highlight those categories.
Yes, see, now if you look at large and mid cap, if you look at large and mid cap, 41% of the schemes in that category have outperformed as per our study from 2018. Because 10-year study may not be as important, Kavita, because in 2018, SEBI came up with categorization. So categories were born in 2018. So it was very smudged in the past. There was not such a clear definition to what was small cap, what was large cap, what was mid cap. So let me highlight large and mid cap as a category. Only 41% of the schemes have outperformed the benchmark. So 59 have underperformed benchmark. But the interesting part is the ones which outperformed have outperformed by 4.32%. So it's the extent of outperformance which becomes very attractive. Now, if you look at mid cap, 42% again, very similar, have outperformed its benchmark in our study from 2018, because that's when categorization was born in the new form and shape. And they've outperformed by 6.7% in our study. So I think wherever there's more freedom, it has created extra alpha, not just the number of schemes, because you're not going to buy all the schemes. It's about how much will they give you. When they give you outperformance, 0.5% outperformance is also outperformance. 10% outperformance is also called outperformance. But they're very different numbers, right? So both the number of schemes outperforming and the extent of outperformance becomes far more important than the number of schemes outperforming as well.
Rose, one thing that I want you to explain our viewers is that we are stressing on SIP performance. Now, how do you calculate this SIP performance and what kind of performance and return are we looking at?
I think when you're looking at SIP performance, the practical situation of most of India is 14,300 crores has come in the form of a monthly installment. Does not belong to one person, it belongs to crores of people. So if there is one person who's doing an SIP for 5 years, he has 60 investments in the same scheme. Now, if the small cap fund, for example, moves up and down a lot more than a large cap scheme, an SIP return will be better than a lump sum return for a volatile fund, because SIPs try to capitalize on price movement. So SIP return, by which they mean the weighted average return of 1,000 rupees invested in 60 different installments, what is the percentage per annum return of that? And if you're wanting to check the extra return made by the fund manager, each and every transaction has resulted in an extra return or a lower alpha or an extra or a lesser. So the cumulative 60 transactions extra return will be the alpha of the SIP.
Rose, now looking at this data, which are the few categories where you would recommend a passive approach, a passive strategy to investors?
See, the usual suspect of large cap category, which you also several times advocated, Kavita, we're saying that if my large cap exposure, I take it the passive way and save my cost there, I think that's still a very, very valid argument. And I would concur to that. So large cap exposure, pure large cap fund, you might as well buy an index, which is 100 top 100 or Nifty 50 also could be a great index to buy. because it's a self-fulfilling prophecy. Nifty is the largest index of the country. Lot of employee provident fund money also goes into that index fund, so they are bound to do well because liquidity chases them, and their P's go up, their market cap goes up, again weightages go up. So it's a self-fulfilling prophecy, especially the Nifty, given the vicious cycle of liquidity resulting in more price rise resulting in more Nifty liquidity.
Right. One last question, Feroze, and we'll take a break, and post that we'll be joined by our viewers also. So here we are talking category-wise. We're talking about the flow through SIP in these categories where there has been a dip seen or not performing more than the benchmark in last 10 years. But then do you think an investor, after listening to this discussion, needs to also consider the kind of fund and the way it has been actively managed in order to decide to whether invest in it or not?
Yes, Kavita, in our belief, the extent of mathematics needed to zero in on a scheme is extensive. Our research group spends 3 months, Jan, Feb, March, to just come with 2-3 changes in the model portfolio. Will categories help you narrow down your choice? The answer is a big yes. From the category, which are the highest probability ones, which will come in the list of outperformance, is a rigorous exercise. Third point is, if you are able to attach significant importance to the individual, if you're able to understand the person behind and his capability, then your choice of schemes is going to be that much more, right? So yes, it's not just the category. Category brings down your 380 scheme universe to maybe 148 in our case. After 148, you have to buy only 14, which is 10% of the whole 148. So you give importance to fund managers, try and get into the constituents of the schemes, because every portfolio is nothing but a group of stocks. So if you want to understand the group, you have to get into the basket and see what's there in it. So that can be done only if you take it up as a full-time job. So use a distributor or advisor whom you think has the capability to at least give you a larger proportion than the report which you see. 62% underperforming is, of course, a startling number. You don't want to be a large part in 62. You want to have at least 60-70% of your money in the other 38. That will require a lot of number crunching.